Hello, and welcome to our 2025 Market Update webinar. I'm Wilde Advisor Anthony Costantino, and we're excited to have you join us today for this important conversation on the market outlook for the year ahead. Before we dive into the market update, I'm thrilled to announce our special guest, Gene Goldman, the Chief Investment Officer of Cetera. Gene brings a wealth of knowledge and expertise to the table, and we're so lucky to have him lead today's discussion on what we can expect in the markets in 2025. As always, our team is committed to giving back to the community. And this quarter, we're proud to feature the Massive Project of Arizona as our charity. This incredible organization is led by volunteers who work tirelessly to serve free meals, lead community cleanups, and address issues like homelessness and addiction. Their motto, "Make America Safe Again," is a call to action for all of us to contribute to a more compassionate and unified community. We're hosting a donation drive to support the efforts of the Massive Project. If you'd like to get involved, please visit our website for more details on how you can make a difference. Now, let's turn it over to Gene Goldman, who will take us through the key market insights and trends for 2025. Gene, the floor is yours.
Hey there, this is Gene Goldman, Chief Investment Officer for Cetera Financial. Welcome to my presentation, 3 investment themes for 2025. What we'll do today is do 3 things. Number 1, I'll give you a quick recap of the markets last year. I know the markets were very interesting in terms of some of the narrowness that we saw, and there's some really important points that we can glean from it. So I'll talk about that. Number 2, I will talk about our 3 investment themes. And number 3, I think most importantly, I'll talk about why we do think that markets could be a little bit weak near term, but overall we do expect a pretty good year. Because whenever you have a year of modest economic growth, moderating inflation, double-digit earnings growth, and a Fed that's not raising rates, markets tend to do okay, but not great. So I'll talk about sort of that in terms of our 3 themes. So again, a quick recap, our 3 investment themes, and kind of weave in sort of near-term uncertainty, but still a pretty good year. So if we dive right in to last year. So last year, let's look at the markets, what they did. And the markets, I'll really focus on the S&P 500. And as a reminder, the S&P 500 is an index that represents 500 companies, the US stock market. So just to think about how interesting it was, look at this. Last year, the S&P 500 returned over 20%. That was the second year in a row it returned over 20%. And that's the first time that's happened since 1998. Also, just to show you how narrow the market was, if you think about the S&P 500, the larger companies contribute more of the return to the index. So if you think about last year, the S&P returned about 25%. But if you actually equal weight the index and take each stock represents the same amount in the index, so all 500 names represent an equal amount, that index was only up about 11%. This shows you the boost that the index got from those big Mag 7 names. And Mag 7 names drove about 63% of the returns. Also, we saw 57 record closing highs. So if you take the number of closing highs and divide it by the number of trading days, about 22% of the time, 1 out of every 5 trading days, the stock market set a record high. And this is just the 7th year since 1953. We've had over 50 record highs in a given year. And 1953 is important because that was the first year the stock market traded from 6 days a week to 5 days. And then also, lastly, we did not see a correction. And a correction is when stocks fall from top to bottom by 10% or more. We didn't have a correction last year. So all this together creates an interesting market as we move into 2025. So 2025, here are our 3 investment themes. So last year, let's take a step back and look at our themes for last year. So last year, we laid out 3 themes. We said, number 1 is that the Fed would go from being a foe to a friend. They go from raising to cutting interest rates. Our second theme was that the economy avoids a recession. And our third theme was that market volatility would increase. If you kind of give us a scorecard, we were right in 2 out of 3. The Fed cut rates. We didn't have a recession. And although we saw some bouts of volatility, overall volatility was pretty low. We did see markets swing a little bit up and down in, I think, January and July, and of course in December of last year. If we turn to this year, here are our 3 themes that we think will guide the economy and the financial markets. Number 1, we call it the Great Moderation. Everything is moderating, the economy, the labor market, and I'll show you some examples. Number two, this kind of ties into the theme that we talked about last year about the Fed going from being a foe to a friend, the Fed going from raising to cutting interest rates. We think our second theme is the Fed ends up proving to be not as good of a friend as you thought they were. They cut rates less than the markets had anticipated. And lastly, our third theme is that diversification is back. Basically, that investment strategy of allocating to different parts of the market is going to make sense in an environment that's pretty volatile, that has a little bit of near-term uncertainty. So let's dive into each of these one at a time. Of course, the first one, as I said, is called the Great Moderation. Everything is moderating. So, for example, the economy. You look here, and this kind of, most of my slides are organized in the same way. Horizontal axis is time, and the vertical axis is a data point. You see here, this is quarterly US GDP. This is economic growth for our economy. And you see from 2021, and you follow the red arrow down, nearly every quarter, this data has gotten slower and slower and slower. The US economy is moderating, coming out of the post-COVID surge that we saw. So overall, the economy is moderating, it's slowing down. The question we sometimes get is, well, the economy is slowing down. Are we headed towards a recession? And we don't see a recession for at least the next 12 months. And there's many reasons why, but one of the big reasons that we point to is parts of our economy that are struggling, that are in recession today, are stabilizing, if not actually improving. You look here, for example, what's in recession? Housing, because of high mortgage rates and lack of inventory, and manufacturing, because manufacturing, during COVID, everyone bought tons of goods, and then companies started to produce less and less, and manufacturing really slowed down. But if you look at this slide shows two of the most forward-looking indicators for housing and manufacturing. Housing, it's building permits, and manufacturing is manufacturing new orders. And you look at the two lines, both fell dramatically around 2022, and now they've stabilized. And now see those little red arrows? They're starting to improve. So areas in our economy that are in recession are starting to get out of the recession, are starting to improve. You take this as a whole, we do believe that the economy avoids a recession because our worst parts of our economy are starting to get better. Another area that's moderating is the labor market. So if you think about the labor market, we look at what's called the unemployment rate, the number of people unemployed divided by the total people working, or total workforce. And if you look at the unemployment rate, it went from 3.4% up to 4.3% and back down to about 4.1%. So it's gone up and down. Overall, it's kind of slowing down. It's moderating because the unemployment rate is rising a bit. But if you look here, here's a better way of looking at this. This is monthly job growth, and this shows you month by month by month the number of jobs created in our economy. And you see the red arrow? It's all slowing down. It's all moderating. Again, another part of our economy. The overall economy and now the labor market are both moderating. Another thing that's moderating is inflation. This is core PCE. This is the Fed's preferred measure of inflation. And there's many ways to look at inflation. You could look at the consumer price index, producer prices. Here, core PCE, the Fed prefers this measure because it's more diversified, it's updated very frequently, and the Fed has a 2% target. You see, looking at trailing 3, 6, or 12 months, it's all rolling down, it's all moderating, it's slowing down. Yes, it's been a little sticky lately, been choppy a little bit lately, but regardless, it's all moderating, it's all slowing down. Again, another thing moderating in our economy. And then the last point is equities, markets, stock market returns. Remember, we had 2 straight years of 20 plus gains. Generally speaking, we do think equity returns, stock market returns will moderate a bit. One key reason is that valuations are extremely high. So this chart shows what's called the price earnings ratio of the S&P 500. The S&P 500, again, that stock market index, and the price earnings ratio, the price of the stock market divided by earnings. The higher it is, the more expensive it is. You see today on the far right, it's at 22 times earnings. That's expensive. The 10-year average, as you see here, is 18. The 20-year average is around 16. Stocks are pretty expensive right now. Given that the fact that they're very expensive, it slowly reduces future expected market returns. Again, market returns are moderating. So the first theme is simply this: everything is moderating. We're calling it the Great Moderation. The economy, the labor market, inflation, and of course, stock market returns are going to start to slow down. Our second theme, again, the Fed. The Fed is not a good of a friend as you thought they were. They're not going to cut rates as much as was anticipated last year. If we look at this, first of all, we do believe the Fed is a friend. The Fed is not raising rates, excuse me. They're either going to pause or cut rates. So the Fed is a friend to the market. They're not raising rates. But they're not as good of a friend as we thought, because if you see here, the markets are leading the Fed. So what this shows here, this shows you the implied Fed funds rate. This is basically the market's calculation of where they see the Fed funds rate, the Fed's primary interest rate, to be at the end of this year. Right now, that interest rate is at 4 3/8. The market expects, and you see that little ziggy-zaggy line, the market expects that the Fed funds rate, that interest rate, will be at about 4 1/4 by year end. Really, that's a sharp rise. See the red arrow? Just a few months ago, back in September, the markets thought that it would be down to 2.75. The markets are telling the Fed, we don't expect you to cut rates as much as you said you were. And in fact, you look at that horizontal line where it says 3.88%. In December, the Fed released a report called the dot plot, the summary of economic projections. And they said that at the end of this year, the Fed funds rate will be at 3 7/8. And right now, again, it's at 4 3/8. So basically, the Fed is saying we will cut rates twice in 2025. In September, the Fed said they would cut rates 4 times in 2025. But now the markets are saying, we don't believe you, and you are not going to cut rates as much. This is upward pressure on the Fed to cut rates less than they had anticipated. I think a better way to show this is just the disagreement that we're seeing within the Fed. So if you think about the Fed identifies what's called a neutral rate. And a neutral rate is an interest rate, a Fed funds rate that does not slow the economy down, nor does it stimulate the economy. It's neutral. And the Fed said, and this is their dot plot here, and the dot plot is where each Fed member anonymously indicates where they see inflation, economic growth, labor market. And each dot is each member anonymously indicating what they expect. The Fed overall said our neutral rate, that ending interest rate, will go from 4 3/8, where it is today, down to 3%. That sounds good, right? But if you look at that red square, the spread is so wide. Some Fed members are saying it's going to be at 3.9%. Others are saying it's going to be at 2.4%. There's a wide disparity in terms of where that neutral rate will be headed. That's an important point. There's a lot of disagreement in the Fed in terms of where interest rates are going. This disagreement, this confusion, this uncertainty creates a headwind for the market. We'll come back to that in a second. And there's more risks in the market. You look at this chart. This chart shows a 10-year Treasury bond. And the 10-year Treasury bond prices in economic growth, prices in inflation. And see, on September 18th, when the Fed first cut rates last year, that line has moved up consistently all the way since. This is the market saying, Fed, you got to be careful. There's more inflation, there's more economic growth, more than you had anticipated. So this says that the Fed may not cut rates as much as they wanted to when they said last year they would cut rates this year 4 times. And you take all this together, inflation expectations are rising. This is from the University of Michigan survey of consumers. And the University of Michigan asked you and I, hey, where do we see inflation 1 year from now? See the red arrow? It went from 2.8% all the way up to 3.3%. That's a big jump in just 1 month. This is basically you and I as consumers saying we expect inflation to rise. And again, as we've talked about this before many times, if inflation is rising, the Fed can't cut rates as much as they said they would. So first theme is the great moderation. The second theme is that the Fed is not as good of a friend as we thought they were. They don't cut rates as much as expected. Now, the third theme kind of takes us all together and kind of in terms of providing you a good investment strategy. So I said this at the onset. I said that we expect for 2025 to have a good but not great year. Again, modest economic growth, moderating inflation, double-digit earnings growth, and of course, a Fed not raising interest rates. Historically, the markets have done good but not great in those types of years. We do think that environment persists for this year, but we do believe that near term we could see some uncertainty, some volatility, some market challenges. And the reasons are, as I mentioned before, Fed uncertainty, Fed confusion. Also, rising bond yields. Rising bond yields makes it more expensive to borrow money, more expensive to purchase items, more expensive to finance projects. But we do expect any pullback in the stock market to create a buying opportunity. So we continue to believe pullbacks in the stock market represent good buying opportunities. So uncertainty near term, again, Fed uncertainty, bond yields moving higher. And the third thing is just these weird market dynamics. You take all this together, we do believe diversification is an important strategy. And I'll talk about that why in a second. So some of these weird market dynamics, if you look at this chart, the S&P 500, the stock market index, has gone up 48% since the stock market correction back on October 27th of 2023. That's a straight line. Stocks don't do this. They need to take breaks. They need to kind of take a pause a little bit. We've seen a nonstop upward move in the stock market since October 27th of 2023. The ramifications are you have high valuations, as I talked about before. You also have just this pricing and everything being perfect. Another issue for the stock market right now is that optimism is so high, and optimism is a contrarian indicator. Here's a survey. In the survey, people are asked, you and I are asked, do we think stocks will rise in the next 12 months? A record 58% of us believe stocks will be higher 1 year from now. That's significant optimism. That's a record high. Remember, it's contrarian. The more optimism, the more caution there is. So again, this is contrarian. Another contrarian indicator, this is from our friends over at the St. Louis Fed. They plot what's called equity ownership. So if you look at total financial assets, what percent are in equities? Right now, it's a record high of 43.4%, as you see here on this slide. What's important is that that's a record high. And you look at this chart, which goes back to the 50s, we've never seen anything close to this. Now we are at record levels of equity ownership. Again, a contrarian indicator. If everyone is optimistic about something, it's contrarian to the stock market. Also, another concern we have about the stock market is the high concentration. This shows, for example, the top 10 names in the S&P 500. Remember, there's 500 companies, but the top 10 names represents about 37% of the index. The other 490 companies represent about 63%. The index is very top heavy. If one of these large companies, and you know who they are, the Mag 7 plus a few more, if one of these companies misses an earnings estimate or disappoints in earnings, the index could take the force of the brunt of the force. So something we're concerned about. Also, we're seeing a very strong dollar, a dollar rallying. See the red arrow? The dollar is up significantly. If you look at US companies, large cap companies, we get about 40% of our revenues from outside the US. A stronger dollar makes our goods more expensive. It reduces revenues. It hurts our sales outside the US. This is a concern that we're watching carefully. And of course, the government. We have a lot of changes going on in Washington. One of the biggest things to think about is the amount of debt that we have. This slide shows from the Congressional Budget Office the federal budget deficit as a percent of GDP. So budget deficit as a percentage of GDP. Dark lines are actuals. The light blue lines are expectations. And you see debt is significantly higher than it has been in a long time. The problem here is that one of the reasons the markets have been optimistic is, under President Trump's 2.0, his new administration, that they're going to cut corporate taxes. But corporate taxes are already consistent with other G7 nations, and we have a significant amount of debt. If he tries to cut taxes, he has to finance it with other revenues, and it's going to be very difficult in a very high debt situation. We also have concerns around tariffs. We had some news recently about Trump announcing potential tariffs on China, Mexico, and Canada, clearly creating a bunch of market volatility. Tariffs create inflation. Tariffs could slow down economic growth. You take this together, you have to watch this as this adds an uncertainty because these costs of tariffs get passed on to consumers, or companies have a harder time with supply chains, with getting items and getting input goods from China, from Mexico, and from Canada as these tariffs do progress. With that said, though, the good news, look, if you look at this chart shows that despite uncertainties around tariffs and concerns, generally speaking, the first year of a presidential cycle is pretty good for the market. This chart shows since 1949, on average, the first year of a president taking office, the stock market has returned about 11.6%. So whether it's an incumbent, a challenger, or a Democrat, a Republican, stock market tends to do well in the first year of a presidential election. So we talked about our third theme is diversification. It's diversification is allocating to different parts of the market. Why do we believe in that? Why is that our theme? Because we do believe a pullback is possible in the stock market, is potentially more than possible, probably likely. The stock market needs a rest, and we have some weird dynamics around concentration, around too much optimism. A pullback in the stock market creates a lot of volatility. And one way you mitigate against this volatility is use diversification. You have exposure to different parts of the market. And diversification makes sense right now. First of all, from a valuation standpoint, this slide shows three lines. The dark line is the PE ratio, the valuation of large cap stocks. The light blue and the yellow line shows valuations of small caps and mid caps. And you see other parts of the market away from growth and technology and large caps are pretty attractive from a valuation standpoint. So having exposure to different parts of the market helps to mitigate some potential volatility. Also, if we do see a pullback, and something we talked about last year, any pullback, in our opinion, is a buying opportunity. Two key reasons why. Number one, you look here, we have significant amount of cash on the sideline. There's about $24 trillion of money market and cash and savings accounts. What we've seen over the last couple of years, any pullback, any correction, any sell-off has been a buying opportunity because this money is on the sideline waiting for better valuations. Case in point was July of last year. Stocks fell from top to bottom by 9.8%. Money moved in quickly to take advantage of those cheaper valuations. We do believe, given business-friendly Washington, given the fact that Fed is not raising rates, modest economic growth, all the reasons I mentioned before, stock market looks good for this year, not great, but good. So any pullback is a buying opportunity. Another reason is that earnings look pretty good this year. See the red circle here? Earnings for the S&P 500 this year are expected to rise 14.7%. That's a good number. That's a great number. And there's the old adage, earnings drive stock prices. Companies generating stronger earnings tend to see stock market investors go in and buy those companies. Again, higher earnings attracts shareholders and so on. This is good for the stock market. So overall, we do believe a strong earnings backdrop will be good for stocks. So our three themes are simply this. Number one is that everything is moderating. We call it the great moderation, the economy, labor market, inflation. Second of all is that the Fed proves to be a friend, but not as good of a friend as you thought they were. They aren't raising rates, but they probably aren't going to cut rates as much as the markets had hoped last year. And third of all, given the fact we see maybe a near-term pullback, maybe a correction, but we still foresee a very good 2025, we do think any pullback is a buying opportunity, but to stay in the game, to kind of stay and smooth out those uncertainties, that volatility, use diversification. Diversification is a way to diversify your assets into different parts of the market, like value and growth and large cap and small cap and fixed income and equities. Again, use diversification and sit down with your advisor to go over. And your portfolio is probably already diversified, but just to make sure, is it too aggressive or too conservative relative to your long-term objectives? And how do we do this? Stay in contact with your advisor, and please focus on your long-term advisor in terms of any changes to your strategy, your perspective, any changes in your life. They need to be aware so as to make sure your portfolio is aligned to your objective. So with that said, I just want to thank you so much. If you want to follow my team and I, we're right here on Twitter, or you can follow me. And I need to show you these disclosures before we forget. And with that, I really want to thank you, and I hope you have a great day. Thank you so much.
Thank you for joining us for this valuable market update. If you have any questions or need further information, please don't hesitate to reach out to our office. We're here to help. We hope you found this session insightful, and we look forward to connecting with you again. Talk to you soon.